or go to decoded.axiafutures.com/1. You'll be able to sign up there, and that way you'll be able to get the replays of this. You'll also be able to join Telegram. I talked about a trade on Telegram that I'll actually be talking about in a little bit earlier on today. I actually called it before it happened, and then on the back of that, we sort of got to see what exactly happened. It's a fantastic example, particularly as at the moment we're going to be doing order flow and looking at price ladders. Fantastic example of what you do not want to see. So I'll be explaining that a little bit more detail in just a moment. As you can see down the bottom, we just want to give a few people a little moment to get settled. Trading floor, you can see there. That's typically where I sit, far right hand corner. One of the traders getting a new screen, hopefully not the damaged screen, hopefully just a fancy new screen. But nevertheless, new screen coming in. So I'll be in tomorrow. So I'll give you a little kind of walkthrough from my seat up on that floor. We'll then go and run through session 3 tomorrow. We'll be covering profile in a lot more detail. So come along tomorrow. You'll be able to see a little bit of the floor. Also, of course, we'll be doing profile. We've got a little bit of an echo. Okay, give me just a moment. I'll have a quick check of that. Shouldn't be too much on my side. So all looking okay there. Right. Let's get that off. Right. I'm going to assume that everyone is now here who wants to be here. So we'll get all of the traders out of the way and we'll get on with it. What today is all about, of course, is order flow. How do you optimize order flow? We're looking at tools. So what tools are you using to visualize order flow, to understand order flow, to enable you to leverage your trades up? Because that ultimately is what order flow does for you. It gives you that little bit of real-time action that you can see what's happening right now. And that allows you to leverage trades up. Great example of that this morning. I got one of the traders to give me a video of it, so I'll be able to show you his exact execution of that in just a little while. So that's coming up. Right, order flow then. What we're looking at then, and I know I often get a lot of questions about this, different types of order flow tools, but I saw questions yesterday around order flow from the perspective of footprint, bookmap, and we're going to go and look at price ladder today. Right. So what are you getting from a price ladder? And this is the way that I try and look at it. And I'll show you a very quick sort of breakdown of this in action in just a moment. What I take from a price ladder is you're able to see the entire market. You're seeing everything that's going on. You're seeing all of the passive participants. You're seeing the aggressive participants. So what a price ladder is giving you is what is happening right now. Footprint, fantastic tool. We looked at it yesterday. What footprint, as I pointed out yesterday, I think is very, very good at doing is allowing you to get a sense of expectation of what's coming next because you're able to see the way a market traded in certain areas. The way footprint does this is it only shows aggressive orders. It only shows market orders. So it doesn't show you who they're necessarily buying from or who they're selling to. So essentially, footprint shows you what has happened. And then people talk about bookmap. Now, what bookmap does, and arguably I think bookmap's perhaps the weaker of the three, is that bookmap shows you passive orders, limit orders, people waiting to trade or waiting to sell if price rises enough to get to a point where someone will buy from them. And so really what bookmap's showing you is everything that hasn't happened and may not happen. And I think the thing particularly with bookmap, when you look at a price ladder, what you're seeing here, yes, bookmap, this is this jigsaw's version of it. But what you're seeing here is, yes, it highlights where the larger orders are. That's great. But that highlight surely is much better visualized by actually seeing the number as opposed to a sort of color that grades over time. So I'm always disinclined towards bookmap in particular. And really, for me, price ladder has always been the key thing because price ladder shows you what's happening right now and also gives you all of the view of all the participants. You see the market orders, you see the passive orders at the same time. I'll give you a little example of this. So I've got this not just in a static. So I always feel static doesn't really help you all that much. So next bit, I'm hoping this is relatively clear for you guys. So what you've got here then is a moving bookmap on the left, moving footprint on the right, and the price ladder in the middle. So yes, you can see where the larger orders are from the bookmap, but you can see that 500 there, 500 higher up, they're those larger orders. What you also see, large order at 94, that 500. And this is the downside of footprint. It shows 15 traded, and you think, oh, well, there wasn't enough buyers up there. That's the kind of implication. It's the end of the move from that 15. But actually, is it more a case that there were not enough buyers because they saw 500 on the offer? Someone bought into it, and people decided they're not willing to keep that move going. So the footprint lacks the kind of interaction between who did those people buy from? Was that a very small order that they bought 15 into, or was it a very, very large order that they bought 15 into, which in fact is what exactly it was? So with the price ladder, you're able to see all of that going together. I know often it looks like there's loads of numbers flying around, and I often hear people say, well, it gets a bit confusing trying to sort of keep track of everything that's going on. What I'll do before we go and have a look in a little bit more detail about how you use the price ladder to leverage trades up, we'll break this down a little bit more and really want to give you a bit of detail. Sorry about that then, Emberg. Um, Fear not, we'll get onto that in a little bit more detail anyway in just a moment. But what I want to give you now is a little bit of detail about all of the bits of a price ladder. And I talked yesterday about candlesticks and footprint and just trying to simplify things down to the kind of what do you actually need to know. And so what you want to do is break these things down into each bit of information that you're seeing. What do you want to try and learn from that? What do you want to understand from that? I'm just seeing the point and connection issue. I'll keep an eye on this. It seems fine on my end, and nobody's warned me in the background that there's any issues. So all is looking fine. Right. So let's break down price ladder for you. What we're looking at first then is passive orders. Now, the passive orders are here. Passive orders are here. These are people waiting. These are all of the traders who are sitting there waiting to get filled. Either they want to buy, but they're not willing to pay higher prices to buy. So they're going to wait and see if someone will come and sell to them at lower prices. Or they're waiting to sell. They're sitting there saying, yep, I'm willing to sell however many contracts at a specific price. But these people aren't really going to make anything happen. They're just waiting to see if somebody will come and buy from them. Think of it like a shop. Somebody can put a price on something in a shop, and then they have to sit there and wait and see if anyone will actually come and pay that price. So, what you're interested in from these orders then is not necessarily knowing where the large ones are. They can be useful at certain times. But really, what you want to know is when we get to the point where the market trades into them, do they come back quickly? So, do those orders reload? Equally, what you want to know is does the market trade through them easily? If you see a market that can trade very, very comfortably through, so trade bid, 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 very, very easily higher, what that tells you is these passive orders are not standing in the way in any shape or form. The other thing that gives you a little bit of a clue is whether they're changing quickly. Passive orders that aren't changing very quickly say to you, well, nobody's really worried about what's going on. Nobody's forced to do anything. Nobody's urgent to change their mind. So therefore, nothing's about to happen. Think of it like a crowd of people. You have a large crowd of people. As long as no one moves, the crowd of people will stay quite tightly packed and nothing will happen. But once people start moving, the crowd disperses. That's what you're looking for from those passive orders. And that's it. Don't overcomplicate it. This example, we've got a position here. So long at 68, another limit order. So limit order being a passive order, an order where you're waiting to get filled. So next up, aggressive orders. This is what makes things happen. This is what you see from a footprint, but what you don't see from a footprint is what they're buying into. So what an aggressive order looks like is this. This is your last traded quantity. And you'll see this when I show a ladder moving in a moment. What last traded quantity does for you is shows you exactly that, the last amount that traded. What this enables you to do is see, first up, the size that's being traded. So 153 here, that's a pretty decent sized order. And that takes away all of the offers. You see there's only 16 offers left. And then the market can trade more easily higher, unless, of course, those 16 come back. The other thing that you're interested in is speed. How quickly do these orders keep on firing in? Because it's very easy to sort of say, oh, yeah, well, the orders are coming in quite, there's a larger order. But unless they're coming in and repeatedly moving quite quickly for your market, then this doesn't tell you a great deal. If I give you a quick little example now, I'll bring an S&P in. This S&P real time right at this point in time. What you're looking at from this last traded quantity then, if we just focus on the last traded quantity, you're looking for the speed with which this changes and the size of the orders. Now, you're seeing a lot of kind of ones, 20s, twos. There's not a great deal going through here. It's not for the S&P super quick either. So this wouldn't be something that would get me thinking, yes, the market's about to start moving here. What I'd want to see is more consistency in the direction of the orders. That's the bit that I'm interested in. If I think this is going up, I want to see the last trade quantity trade 71.5, then 71.75, and then keep on going 72, 72.25, 72.5. Keep on pushing. The fact that it's not and it's rotating slightly is saying, well, it's time to wait now. Nothing's suddenly going to happen here. It is steadily starting to tick higher, and that's following on the sort of continuation of a rather bullish looking market. There you go. Once again, you see the market pushes back down. So that rotation, that rotation doesn't show you that there's much direction. Bookmap in itself won't show you that. Without a price ladder, you can't see the transaction between how the passive orders are being hit by the aggressive orders. That's what a price ladder gives you. So we're seeing a little bit of rotation. Arguably, you're starting to see a little bit of a push towards the downside. There's not that much going on at this point in time. What you're looking for is consistency in the pace and a pickup in pace. This hasn't changed. The pace has been relatively steady in both directions. So that's the main thing that you're looking for on that last traded quantity, the pace and the size of the orders going through. Next up, the volume profile. What the volume profile does for you on the side is it gives you a sense, and I'm quite a big fan of resetting your volume profile, particularly if you start a new move. Then what the volume profile will do is show you where you're able to start seeing volume accumulated. And the way to look at this then, and this is a great little example here, volume accumulates here. So the higher an increasing volume shows you acceptance. What this means is people are willing to trade at these prices. Now, acceptance is, and I'll go into this in much more detail because it is a sort of profile concept. Acceptance is limiting if you've not gone anywhere and we're accepting trade in the same area, but it promotes continuation if it happens at higher and higher prices or at lower and lower prices. The white horizontal line is the midpoint, or sorry, it's not the midpoint, it's the last point that you recentered your ladder. So it's the midpoint when you last recentered. So that's what that one gives you. So acceptance. What acceptance does then is that shows you in this instance a market that is willing to trade at higher and higher prices. Bring the S&P back in very quickly. And what you're seeing here, we had acceptance lower. Then the market trades higher. Then we get acceptance higher, more volume building up, then lower volume and higher volume. So we're seeing acceptance at progressively higher prices. This is a good indication early on of a potential trend day in the S&P. So that's what it's showing you if you got direction. If you don't have direction, though, then you have a market that just trades within that band of acceptance. The other thing that you have is rejection. Rejection is shown by low volume. When I say rejection, what I mean is an unwillingness to trade those prices. Not a rejection as in we trade up or move away, which is what most people think, is a lack of willingness to trade those prices. So what that does for you then is it shows you that the market is less likely to trade down here. Look at the S&P down here. This is just below the previous day's high. So we trade up, straight through yesterday's high at 66 and a quarter, and then we accept trader at higher prices. Similar thing here. So you can then place your stops where there is rejection on a move higher. In this instance, long at 68, offers on a break of the high, and then stops just inside that low volume zone. The low volume shows you a rejection of prices. So now you've got all the three key pieces of price ladder. That's everything that ultimately you need to know. And it's about the transaction between them. It's about these sort of push and pull across each part of that price ladder. That's the bit that matters. So let's go and have a little look at an example. There is the rejection. So sorry, didn't share that bit straight away. Right, this was one that I called on Telegram earlier on. The idea of this poor high in gold. And I'll go into this in a little bit more detail tomorrow when we look at profile and also what then came next. What I'm going to show you is the bit that you don't want to see. And it's really important to look at it like that because too often people only see what works, the kind of perfect example. And that's great. But you also need to know what it shouldn't do, what it looks like when it's not doing what you want it to. So the idea of this trade then, and what's key to any kind of action on price ladder, just like we talked about with candlesticks. Candlesticks give you a point of reference. You expect something to happen there and you want to do something. In this instance, this is what you would describe as a bad high. And like I say, I'll go into more detail on this one tomorrow. What a bad high tells you is basically the market should break. You do not expect this to trade here and roll back. So your plan is to buy. What we're then looking for is a change in the pace on the ladder. Once you get that change in pace, that's where you're then going to get the breakout that you're looking for. So if I go and show you what happens, and remember, this is what you do not want to happen. Look at the passive orders. Nothing is going on. Market is very slow. It almost looks like it's stopped. There is nothing happening. Yes, you've got a large order just up here at 67.7, just before the high. But look at the orders. Nothing's happening. The last traded quantity isn't really moving a great deal either. And then it jumps. So you get this one quick jump. If you're not in the trade, and you shouldn't be because nothing's happening, then you have to buy after the jump. And that's fine. There's nothing wrong with that. The expectation is this continues. But when it doesn't, and when the pace of orders completely slows down, the passive orders don't change again, this is a prime example of a market that just doesn't really want to go anywhere. This is the situation. You look at this and you think, this trade's not going to work. That's what a price ladder allows you to do. It allows you to take this trade on and then say, okay, it's not working. From a candlestick perspective, you're over the level. So your view from a candlestick is this must keep going. And that then leaves you in a situation where, excuse me, where you're looking for something that just isn't likely to happen. That ability to see on a price ladder, that lack of action, that lack of energy within the market tells you everything you need to know. It tells you this is not the time to be in and you need to consider getting out of the trade. You either place a stop, give it a chance and see if it will go, or alternatively, you get out here and accept that this just hasn't got the legs to do what you want to do. Thanks, Walter. So there we have it. That's what you don't want to see. And it's so crucial, I always feel, any time I'm trying to explain anything to anyone, to actually give them what goes wrong, because that's the bit that most people don't focus on. They only focus on what goes right, which is great. But when it doesn't go right, what do you do about that? So let's then go and have a little look at what a price ladder gives you. Price ladder's greatest gift is leverage, because what a price ladder allows you to do is see that immediate dynamic change. You take that example we just looked at. In gold, there is no way you're adding to that position. Nothing about the way that the market traded there, that lack of energy, that very lethargic action, suggests that you should be adding to that trade. Therefore, you don't increase size when a trade doesn't look good. But what you can do is increase size when the trade does look good. So you leverage up an opportunity when it becomes clear. When it says to you, yes, now's the time to get into this trade. Information incoming as a trade progresses is what makes a trade better, is what tells you to add to a trade. So let's go and have a little look at leverage. Before anybody asks, and this is something that I think people get into a lot of problems with in trading, and what they look to try and do is achieve a high win rate. Now, I've been in the business for 15 years now. I've seen hundreds, if not thousands, of traders come through. Nobody has much better than a 50% win rate. Fact. So there you go. Win rate isn't going to do anything. And think about it from the perspective of how do you expect to have a high win rate when there are so many other people out there trying to do the same thing as you? Ultimately, when you enter a trade, there are two outcomes: it goes up or it goes down. So the outcome is binary. Therefore, you cannot possibly have a particularly high win rate. I know people will have say that yes, someone's got a system that does it. I'd have a pretty good guess that it doesn't. What allows people to make money with a 50% win rate? And this is just so that you can see there on that the couple of little charts I've got there. This is the last week. So from the beginning of last week up to where we are now. This is per hour performance, distribution of winners and losers, long and short. So pretty 50-50 on long and short, just shy of where it's around about 43% win rate. All of this on live. So these are all the traders' performance. So you can see the kind of whole scale. This from TradeAbate. We not TradeAbate, Genelytics. We've got that for our sort of entire firm, so we can see everybody's performance. But what this shows you then, the red and the blue obviously being profit and loss per hour. What's going on here then is pretty even distribution of winners and losers. But what you're then seeing, look at the amount of times, and these two pink lines are evenly distributed. So two sort of deviations higher. Look at the amount of times that we get trade above that and miles above it, significantly above it, hour after hour this morning. That's what leverage is all about. These weren't trades that these weren't trades that you know suddenly had a high win rate. A high win rate isn't going to make you more money per trade. A high win rate will mean that you don't have many of these red bars and you can see a lot of them. It's leverage that makes the difference. Because what leverage does is when a trade is looking right, this is the key to leverage. When a trade looks right, you add to it. And I've seen the comments before saying, well, you had a good position to start with. Why would you make that? Why would you reduce your average price or make your average price worse? You're not thinking about it like making your average price worse. You're thinking about it from the point of view that you have a situation where the incoming information the incoming information tells you that this trade is now more likely to work. Well done to you, global jobber, if you managed to achieve that. So well done. Next up, add leverage to that. And on those 63% of winners, you're going to have a much, much better performance if you can spot when those trades are going to work. That's the key bit. It's incoming information that allows you to recognize a trade is going to work and then allows you to leverage that trade up. Ultimately, and this perhaps my favorite quote from anybody in trading is the way to build superior long-term returns is through preservation of capital and home runs. I think that's illustrated perfectly here. When there's not major opportunity, when the market isn't skewed in your favor, you don't leverage up. Therefore, you end up with relatively flat returns. And that's fine. Because when you get opportunities, then you leverage up, then you get paid. So that's the performance over the last week and then Monday, Tuesday this week. And it's all come from taking hold of opportunities that have come. We're going to look at a breakout in a moment. I mean, this is a bond breakout this morning. There's a couple of people who actually got into the S&P recently. I wanted to sort of talk about the S&P, but the S&P has been very, very quiet and one of the sort of least traded markets for us of late. But there are a few people now looking at the S&P, a few people long S&P, playing this kind of continuation move higher as it has then broken out towards the upside above yesterday's high. And people are then able to sort of leverage, as I said earlier, bring that S&P back in. People are able to then buy one on the break of yesterday's high. Then you can buy as you start to see this acceptance, people buying up here as well, looking for continuation. 75 is the next area that a lot of people are looking for, incidentally, in the S&P. I have seen that on the mouse pointer. Sorry about that. There's not a great deal I can do. It might well be just be the scroll function on the mouse. So sorry about that one. But that's what leverage does for you. That's why leverage is so important. Now, if I try and explain this in a little bit more detail and sort of break it down, one of the first things you have to accept in trading is that you're not going to drastically improve your win rate. And whilst Global Jobber seems to have a reasonably good win rate, I would suggest, for most people, that's probably the peak of win rate that you're going to be able to achieve. So how do you make that win rate count? Because ultimately, if you've got a marginally above 50% win rate, yes, you're making money, but you've got to do you've got to do a huge number of trades to make that win rate count, because you're only getting that sort of marginal difference in performance. So let's take an assumption. Now, this is a very broad, basic assumption. Essentially, this is a coin toss scenario. You have a trade idea. Now, if this has a 50-50 win rate, and any trade when you enter has a 50-50 outcome, you enter a trade, it will go up or it will go down from where you enter. So you can back test the idea, but as you enter a trade, there is a binary outcome. So you enter a trade. Let's assume it has a 1-to-1 risk reward ratio. Not ideal, but I know a lot of people who would do that. So when the trade works, you trade it with 10 lots. When it fails, you trade it with 10 lots. Now, if you just did that and did not leverage the trade, you would end up flat over the long run. So how do you make this pay? The way you make it pay is when you get a signal to leverage the trade up. When something happens as that trade starts to move, that you can say, yes, this is one of the ones that will work. It's one of those 50%. And that's what incoming information does for you. It shows you that the trade that you thought was a good idea is actually a good idea. That gold one that we just looked at, it wasn't. And so therefore, you step away from it. You accept that, yes, you may well lose on your initial position, but you're not going to increase the size of the position. Does this apply to every single trade? Yes. You look at any trade, and if it gives the chance to leverage, you leverage it. If it doesn't, you don't. The trades that you really get paid, the trades that you really get paid on are the ones that you can leverage very, very large, very, very quickly. What you're able to do then is sort of grab a decent chunk of a move on much more size than you typically would. So let's take, for example, when you get a signal to leverage a trade, you do it with 30 lots, not 10. So when you don't get any signal, the trade runs to target. Great, you get a winner out of the trade. So now, from your initial trade, 50% work and 25% of those give you a 30 lot winner. So you win on 30 rather than on 10. So what this essentially means then is that your average size on a winning trade is 20 contracts. Your average size on a losing trade is still only 10. That's what leverage does for you. It turns a 50-50 win rate, a trade that ultimately has zero value, into something that you can actually make money with. I'll get to a couple of these points. The way that a ladder helps you better than Footprint is because what Footprint doesn't show you is what the orders are hitting into. So you see a market order come in, but it always shows you what's just happened. You can't see what's about to happen. You can't see the large order that maybe the market's about to trade into. You can't see the passive orders pulling at the point in time that you want to enter a trade. That's what a price ladder shows you. It shows you everybody together. Is there a maximum multiple of standard clip? I'm not going to get into too many questions. A lot of traders will go either 5 to 10 times a maximum clip or 5 to 10 times a standard clip to enter trades with. So let's go and have a look. Trade of the day, perfect example of leveraging up a position. Again, increase in open interest and positive delta. These are things that happen after the move's happening. Yeah, this is already happening when you get the chance to leverage. What you're looking to do is to try and leverage as the move comes along, not waiting for indicators to tell you what's just happened. Because what's just happened, and this is so important, people always misinterpret this. If you've had a lot of buying, what this basically means is there are less people left to buy. Because if I've bought and now I've bought to my maximum size, the next thing I'm doing is selling. So once you get the information that says, yes, lots of people have bought, which is what essentially a footprint will do. Once you get that information, well, all of those people who've just bought are now sellers. So the moment that a move actually looks the best is often the point when actually you've got the point of the most potential sellers in the market. So I don't want to wait for information to come in. I want to be able to take the trade on here and now as I see that information happening. On that point, Bilal, just very quickly, you can't worry about what other people may or may not do in future. Yes, a market may trade higher and get stuck at a level and roll back. And when it does that, you go, okay, the trade's not working, get out of the trade. But you have to take a trade on, as I was talking about yesterday, on the basis that you believe this is going to continue. And so, therefore, as information comes at the next levels, that's when you judge whether it is continuing or not. If it is, you leverage, you add on to the trade. And there's probably a great example of this just coming up here. There will be a replay available. So, just before I get onto this trade, there you go, decoded.axiafutures.com/1. Click on there. You can sign up for the replay. So there you go. Get onto there. Right. Trade of the day. This, again, another 45% win rate on the day. But again, leverage matters. You look at the performance in the markets that generated the income today. Look at the difference in the size of the winners. Overall, markets traded across the board pretty even for the firm. So even number of winners and losers. But this is the point on win rate. 50-50 winners and losers. Look at the payout on the ones where the opportunity came. So what the opportunity is here is all about a breakout trade. And this is something that comes from combined use of tools. You know, he's not taking the trade on the basis, oh, instantly, it was Harry's trade. Harry's the guy on the screen instantly, if you didn't know. This is a trade that comes on the back of decisions made from footprint, from price, from profile, from candlesticks. But the getting down to the action, the what tells you now's the time to buy more, entirely comes from the price ladder. That's the bit that we're interested in. So it's the leverage that comes from the price ladder. The getting in and where to get in does come from the other tools, but knowing when to add to the trade entirely comes from the price ladder. Would this be a good entry on the S&P prior to buying? Just a moment. All right, guys. Sorry about that. That's the mistake you make for trading from the home office or being from the home office. And all right. Sorry about that, guys. A little bit of an issue there. Right. Let's get back to this. So I just saw a few of the comments there. Don't worry, you won't get put down. Let's get on with it. I'll be in the office tomorrow anyway, so you'll be able to see from the trading floor tomorrow. So you'll just get hear traders shouting instead, which is far more fun. Right, let's get down to this. So here's the trade then. What the trade's all about is a breakout of the highs. Now, at this point in the Bund is sitting at the high. And the play here is quite simply a move, and this is quite a small move. It's a move through the highs of yesterday up towards 68, and then with the much larger potential at 34.03, which incidentally the Bund did get to by the end of the day, but after quite some time. The initial move and where the pace of the market comes in, the chance to leverage comes on the break of 50. So we're looking at the speed of orders that come to market. We're looking for faster orders. We're looking for larger orders. This is the chance to buy more. And the other part of this trade, now remember, the Bund here is breaking the high. So Bund breaks the high, bobble them. That's the other trade that he then brings in. And what he's looking for in the bobble, and with the bobble, you're looking for the break of these highs here. So this is the actual move that comes along. But the bit of the move that we're interested in, the bobble's actually trading below the previous lows. So he's looking to get in at around 80 up to 85, which is this high, and then look for a move towards 90 to 96. That's the bit of the move that we're after. Do trade US European stocks as well. We don't trade individual stocks, we trade futures. But yeah, we'll trade across US, European. Yeah, people trade all manner of different markets, whether that's FX futures, commodity futures, equity futures, bond futures. We trade everything. Anything that has potential to move, we will trade it. So they're the two trades. We'll get on to correlations in the coming days. So these are the two trades. Bobble is the buy zone from 81 to 85. And then looking, really, this is just looking for 10 ticks. But it's about leveraging it when the opportunity comes, when the pace comes into the market. That's when you leverage the trade. So let me get this one up for you, and you'll be able to see exactly what I'm talking about. So here we go. I'll show you the ladders. I'll also bring the charts in for you so you can see a little bit more detail. So I'll flick these on and off as needed. What you've got here then is the bottom is a bobble chart, and this is the move we're looking at here. And then on the top is a Bund chart, and you're looking at this move here. We're looking at how does he execute the trade. So let's get this one moving. So here we go. Here's the Bund, and this is the one that he's looking at first. So looking at the Bund around about 133.51, you see the mouse moves higher. So watch the black mouse. That's the one to watch. Little tick up, buys 11 Bund. And he's waiting now for the market to break the highs. At this point in time, it's got that little bit of pace. Decent size order just traded into the high as well. So we're all looking okay here in the Bund. Then brings a bobble ladder across as well. Once again, it's the bobble. But look what just happens. The Bund jumps. And as the Bund jumps, this is now the sign that he's looking for as well to get into the bobble. So the Bund skips up. That pace, that taking out of multiple prices, that is the rejection I'm talking about. He's not willing to keep trading here. And look, 378 straight into the high of the move as well. So this is a great indication that, yes, people do, people do want to start buying now. So let's get going. So he's in the Bund, now hits the bobble. You see very, very quickly hits 12 bobble, then another 12 bobble. Still got the 11 in the Bund. Remember, the Bund target is 68. The bobble is looking for the break of 85, then up towards 91. So willing to hold the position in the bobble, hold the position in the Bund. You're looking for these targets. See, the first couple of orders come in there to exit that first position. So at this point in time, reasonably happy, just comfortably sitting on this trade at this point in time. Now the Bund jumps. Again, another little rejection of price. You're seeing the bobble also getting jammed towards the high. And as the bobble gets stuck to the high, it adds another 12. The reason for that, you saw this 1100 trades into the high just there. So if I pause that very quickly, what you saw as this traded up was that you saw a large amount traded straight into the highest price. That large last traded quantity is a good indication that people are very, very willing to hit at higher and higher prices. We've already seen rejection from lower down. So you're then quite confident that this is going to keep on going. And with that in mind, then you're willing to keep hold of this position. The bund now has broken through 68. So over to the bobble. This is where really the main focus is now. So the goal in the bund now is really just to try and reduce the position down. But you are seeing now this volume starting to build up. And this is now a chance to then go and add to the trade. So it adds to the trade using the volume lower down as the support. The bobble up towards that 96 level, so starts to reduce that position down. What this is all about then is as soon as you see that little bit of pace coming into the market, time and sales would show them. But what you're trying to do is I don't want to be clouding my judgment with too many things that are going on. What you want to be doing is watching the pace of what's going through. So yes, you see that large order, but you see that and react instantly. You don't need time and sales to tell me that, because I'm seeing it on the ladder anyway, because I'm watching this last traded quantity. That's the bit that you're interested in. The last traded quantity, the pace with which that moves, the size of the orders that go through on that. That's what tells you whether this is going to work or not. And that was what enabled him to leverage the trade up. That was what said, yes, go on. You go from 12 to 24, and then you hit 36 as the pace continued to increase. So he was willing to hit that little bit higher up. That was the stuff that mattered. That's what allowed him to leverage the trade. So now it's just a case of trying to wind this trade down. You see that the pace has slowed down as well now. So you just looking at these two ladders, you see it's much, much steadier. The passive orders aren't moving so quickly on the bund or on the bobble. And this is then another good indication of a time to exit the trade. And so what he's been able to do then, is take a normal clip, so perhaps 5 in the bund, 12 in the bobble, and turn this into a 2x in the bund, 3x in the bobble. It's a very, very significant jump in performance on a pretty simplistic trade. It's a quick breakout trade. You play the break to the next level. Essentially, it's not much more than a scalp trade, really. You play the break up to the next level, and that then is the point to get out of the trade. Reduce the size down and bank your winner. This incidentally banked him around about $6,000. So it's a pretty hefty winner to be taken on that trade. And all of that comes down to leverage from seeing that on a price ladder. The speed of that, if you saw it on a footprint, by the time you see what's happened, the move's gone. Your chance to add on, you'd be buying the bund towards 68. You'd be buying the bobble after it's jumped around 90 rather than adding to a position around 90. That's the that's the bit that matters. So to answer that question, would you have been able to add in the bund after the flick? The flick up, yes, you'd be able to add, but you're adding later on. But yeah, nevertheless, after that flick up, if you think there's more in this, then yes, you can keep on going. You look at the bund here, now you're starting to build acceptance. So this does suggest there's another leg in the trade. But the initial part of the trade, the point where the leverage increased the most, was that point where the pace picked up. And it's the ladder that gives you that. Nothing else will give you that level of information. I'll leave that to play. You'll be able to see the sort of continuation of that trade. I'll answer a couple of questions. Just very quickly, whilst we've got a bit of time. So, why not use bid snapshots and Jigsaw for adding and pulling on orders on the DOM? To me, again, a bit like time and sales, I don't think you need to see that. I don't need to be able to see the amount pulled or added onto the bid. You can kind of see that in real time anyway. And I don't want to then be comparing the amount that was pulled to the amount that I can remember was there, and then trying to sort of calculate new numbers in my head on that. By the time I've done that, I've missed the action. I've missed the information that's coming on. Um, So to answer a couple of the others, seems that 45.66 was a good place to add for continuation higher in the S&P. Yeah, absolutely. I think 45.66 was crucial. Yes, it was previous day's high, but that rejection below it, that lack of volume below, was a great indication that this one could keep on going higher. You're looking now for the SP then to actually progress on this, go and break the high with some pace and give it that kick through the highs that you want. So there you go. There's the S&P as it's happening. You want to see this now actually drive through the high, a bit more pace you want to see here rather than last time we were here. This was slow. It was steady. You want to see this go a little bit more pace, ping it through the high. Again, I think adding too many columns and too much information generally is more than you need. Yeah, most of the time you can see what's going on here. You can see that this has got a little bit more stability in the pace to last time we were up here in the S&P. So now what you're looking for is whether this will actually jump through here and actually push this quickly through that level. That's what you want to see. At the moment, it keeps on trading. It's persistent in terms of hitting into those higher prices. That's what you want to see. The last traded quantity is constantly hitting higher and higher prices. This is different to the last time we were here. This is what would make you confident that, yes, this could potentially keep on going. The reason he bought before the high there is the change in the pace. The change in the pace of the market tells you you can buy through the high this time. If you don't get that pace in market, then of course you won't get the chance to buy through the high. But the way people will buy as you go through the high or just before the high is because you see the change in pace just before the high. That's what they're looking for. I've not got a course on footprint, but I will cover that in a lot of other courses. There, and if anything that I do cover, any courses that I do run, I'll always touch on footprint as well. And I bring it in. For me, footprint's a great way to try and learn order flow, to try and learn how a price ladder moves, because it gives you a little bit more detail, at least allows you to say, and this is where I think footprint's great. I thought I saw that on a price ladder. Footprint confirms what you did see, because remember, footprint always tells you what's just happened, not what is happening right now. You can't see orders on footprint. So no, footprint gives you market orders. It doesn't show you what they're buying from or selling to. So that's the difficulty with footprint. Right. So we've got there. We've shown you leveraging a trade up, how to use price ladders effectively. You don't need to be watching price ladder constantly. You need to be watching a price ladder when you get to a point of reference that matters. So I will wrap it up there for you guys. But quick reminder, I will, of course, be on tomorrow. We're going to do trade asymmetry. We're going to look at profile. We're going to look at how you can use your profiles to know whether a trade is now going to work, and also have a very clear expectation of where the market should go and how comfortably it should move to where it's going. Right. I will not answer too many more of these questions. So I will wrap it up there. I'm sure if you've got questions that you really, really want answering, then you can send a message to info@Axia Futures. If it is a more technical question, I won't be able to get back straight away. You know, we've got a lot of other stuff that we're doing, but I will endeavor to answer as many questions as I can. Right. I will see you all tomorrow. Remember, one last time, for those of you who want to see the replay of this, make sure that you do sign up. So decoded.com. Oh, sorry, decoded.axiafutures.com/1. You'll be able to sign up. The page should look like this. Put your details in. You're also then able to join Telegram to come and join us there as well. So I'll be posting more stuff on Telegram as always tomorrow morning. Right. I will leave you there, guys. Have a wonderful rest of your day. I will see you all tomorrow. Catch you then.